Hi guys, good evening and welcome to Money Control Market Weekly. I'm Karunya Rao and here's me kickstarting the first edition of this year 2023 for Markets Weekly, and joining me in conversation today is Gautam Duggad, Head of Research Equities, Motilal Oswal. Gautam, thank you so much for taking time out and joining us today. Wish you all at Money Control at Motilal Oswal a happy new year from all of us at Money Control.
Thanks, Karunya. Wish you and all your viewers a very happy and a prosperous new year.
Well, the markets are not particularly cheery. First week of the fresh new year has concluded, and we've seen some pretty low levels as well. If you look at the benchmark indices, Nifty even breached that 17,800 mark briefly on the downside. Of course, we rebounded a tad from there, but there is still a fair amount of caution, a fair amount of worry that perhaps is plaguing the investor sentiment right now. And if we look at, the January jinx, do you think what hasn't happened in the last 20 years, when for most of the times we've seen January ending on a weak note? Do you think that jinx can be broken this time around?
I see it's very difficult to predict such monthly sort of closing or opening levels based on history. See, what has happened is 2022 we have massively outperformed despite all the challenges, despite all the global headwinds that we had. When global markets were correcting 15-20%, I think S&P 500 was down 19%. European markets were down anywhere between 14 to 15%. Emerging market index itself was down 22%. And in such kind of a backdrop, India ended up 4% higher, right? Second, it is also, you can clearly see it that our valuations relative to the rest of the world has inched up significantly on a relative basis. While on an absolute basis, we are still in line with long period averages, because the rest of the world has corrected, relatively we have become far more expensive. So if you look at our valuations versus MSCI Emerging Market Index, and MSCI India price to earning 1 year forward ratio right now is at a 137% premium. This used to be 160, 165% 2 months back. But still, versus a long period average of 65%, our premium right now is 2x of that. So clearly, relative to the world, we have become far more expensive. And we have seen some of the beaten down markets bounce back in the last 2-3 months. China being a very clear example. It started the year on a very positive note. And post October, I think those markets are up in a strong double digits. So some amount of reallocation of money, some amount of profit booking is quite natural, and it's not as if we have corrected big time. We are still hovering around that 18,000 level, where we were, I think, actually a year back. So all in all, when you look at recent movements from the top, obviously it feels as if we have corrected a lot. But if you take a step back and zoom out, then I think India has done exceedingly well.
I want to come back to that point on valuations which you were talking about. Do you think we have enough triggers, enough fundamentals in place to justify a sort of 2x valuation like you were flagging off to some of our global peers?
See, Karuna, this 2x valuation has not happened by design. It's not as if people came together and said, world is trading at 10x, let's make India 20x. So
Yeah.
what has actually happened is our long period average has been around 18 to 19 times on a 1 year forward basis, which is where we are right now at 19x. But concurrently, the rest of the markets have seen a big beating, and their valuations have corrected significantly. So today, for example, when you look at the price to earnings of MSCI emerging market on a trailing basis, it is about 11 times versus a long period average of 14 times. So they are trading at roughly 30% discount. When you compare the same thing for MSCI India, then our trailing P right now is 25 times versus the average of 23.4 times. So while we are up on an average versus peak, long period average by about 5 to 6%, rest of the world is at a discount of 30% to the similar long period average. And this has happened because rest of the world has seen a bigger slowdown, recession, higher interest rate hikes. They had gone overboard during COVID when pumping in money, monetary easing, interest rate cuts. So all of that is coming back to haunt some of those economies, whereas our macros were very well managed both by the central bank and the government. Right, we didn't go overboard in stimulus. We did a very targeted beneficiary kind of an approach. Neither did we pump in liquidity in the economy. So relatively on a macro front, we were far better placed. Second, our earnings have been resilient. Between FY20 to 23, our earnings will be up anywhere between 80 to 85%. So that's a fairly strong performance. And third, the resurgence of domestic flows. It has helped our market steady despite about $20-21 billion of FI selling in CY22. The domestic flows were roughly about $32 billion. So it is basically quite natural at some point of time that sometimes in the short term your own country specific attributes take over and you can remain divergent from a broader trend where your long period average premium is 65-67%. Today you're at 130-135%. So at some point of time it may even mean revert. We'll have to see how it goes. But what has happened so far, it's partly a reflection of a very strong policy management by our central bank and government, and at the same time extremely strong corporate earnings growth that we have seen for last 3 years, and balance sheet of corporate India is also very light today. So all of that came together and helped India outperform in CY22.
Okay, all right. But do you also have a similar view when it comes to earnings picture? Could we outperform there as well?
See, I don't have a view on rest of the market's earnings because we track only India. As far as India is concerned, we are expecting this year to close with about 13-14% earnings growth and next year to be also in a similar bracket. What I'm concerned about is the general economic slowdown that we are now seeing. RBI is estimating 4.4% kind of a GDP growth for rest of the FY23. Then FY24 also expectations are somewhere about 5 to 5.5%, which is not a very strong absolute GDP growth rate. While relatively we might still be among the fastest growing economies, but given the kind of per capita incomes that we are sitting at, India definitely needs about 6.5-7%. So anywhere below 5.5, in the range of 4.5 to 5.5 is like a slowdown for us, and that will create its own impact on sector level micros and corporate earnings. So that is what we have to be very cognizant of. The emerging downside risks to corporate earnings as we move forward, given the broader economic slowdown that we are seeing and the lagged impact of the interest rate hikes that has already been passed on. We have seen 225 basis point of a repo rate hike in CY22. Our view is that we might see one or two more rounds of interest rate hike, maybe 50 basis point more. So how does this 250 to 75 basis point of a rate hike impact consumption? And obviously it will extract a toll on equity valuations as well. So putting all of this together in a context, I would be very happy if for CY23 also we remain range bound in a plus minus 5% kind of a band. Because it will allow earnings to catch up with valuations and lot of sector to become slightly more attractive on valuation point of view if we time correct a little bit more.
But if we look at the overall market mood or investor sentiment, don't you think that the market's concerns are more about a cyclical slowdown and they're not pricing in any structural change as of now?
Yeah, of course. See, structurally, we are very well endowed as far as our demographics, our overall policy momentum is concerned, the kind of reforms that have happened in the last 5 years. So I don't think we are in a structural slowdown or we will remain in a structural slowdown at any point of time in the near term. But from time to time, there will be some pressures. They may not be of your own making. So right now we are suffering because the global macros are tough. There is a recession in US, there is a recession in Europe, there is a Russia-Ukraine conflict which is brewing up. Then there is problems in China related to COVID. So world has become a very tough place right now. So even though you do well domestically, your export, which has now, by the way, a significant contribution to overall GDP growth rate, that can impact you. And then, of course, monetary tightening plus interest rate hikes are never a happy scenario for a broader economic and corporate earnings growth. So we will have to, basically, buckle up and bide our time till the global macros and overall global economic backdrop becomes little more benign than what we are currently finding ourselves in. But all said and done, structurally things look very solid for India over the next 3 to 5 years, because the lagged impact of the reforms that we have taken, whether it is GST or whether it is the manufacturing PLI, Make in India kind of policy context that we are setting up, all of that augurs very well. And most importantly for India, India's banking sector is in the best of its health in last 2 decades. Whether you look at it from a point of view of the balance sheet strength, capitalization ratios, provisioning coverage ratios, the balance sheets of the banks are the cleanest that they've ever been, and the balance sheets of corporate India are the lightest they have been in the last 12 years. Right now, the net leverage is 0.54. So this is a very nice sort of overall mix which is there. But in the short term, there is obviously some issue because of the global factors.
The reason why I started our conversation today about talking about January and the mood in the start of the year is because uh, earning season will be kicking start very soon. We also have the budget next month. So typically there is a lot of chatter, a lot of anticipation, some amount of volatility as well, and some pockets of the market tend to outperform around this time typically. So if we talk about the earnings picture, this is the starting of the second half and the trajectory, for the rest of the months to follow. Given the fact that commodity prices cooled off a tad bit, most people expect earnings and margins, especially of most companies, to improve. Do you concur with that idea?
Yes, in fact, we had put out a note a month back on the recovery of corporate margins from the ashes. We do expect 2H FY23 and FY24 to see recovery in corporate margins. That being said, the uh, the mix of the sectors which is driving earnings growth right now is very very skewed in favor of financials and autos, right? If I look at my own expectations for the quarter, we are expecting about 8% earnings growth for Motilal Oswal coverage universe and 13% for Nifty. Large part of it is led by financials, and it is getting dragged by global cyclicals like metals and oil and gas, right? And then auto is helping at the margin, but rest of the 12 sectors are pretty much doing nothing, plus minus 5-10% kind of a band they are setting in. So the earnings picture has to become far more broad based for markets to get more confident to read it from here on. Otherwise, it will become a very sector specific approach where one or two sectors which are driving the markets will keep pulling it up, but beyond a point, then it will become very difficult for the markets to kind of carry itself on. And right now, that is a bigger problem because excluding financials and auto right now, most of the sectors are showing deceleration in their demand, volume, and therefore top line growth as well. In fact, yesterday we put out a note on implications of a single digit nominal GDP growth for India, wherein our economist has articulated that after many years, FY24 India's GDP growth on a nominal basis will be in single digit at about 7.5%, and definitely with some lagged impact, it will have repercussions on India's or corporate India's micro performance on earnings and top line growth. So we'll have to wait and watch how that pans out, because a lot of times macros and micros get divergent and they're not linearly extrapolated. So we'll wait and see that. But at the moment, my concern is earnings are getting very narrow and it's being driven by one or two sectors.
And what are the handful of sectors that you think could be the outliers?
So right now, financials, obviously everybody knows about it. They've been the best performers on earnings. In 5 years, the profits have grown from 45,000 crores in 2018 for Nifty financial companies to about 2 lakh 6 to 2 lakh 7,000 crore that we are expecting this year for FY23. So almost a 5x or 4.8x kind of a growth in 5 years. So that is looking the strongest. That aside, auto is bouncing back after 5 years of a massive down cycle that we have seen. So when banking earnings bottomed out in 2018, in the same year auto earnings peaked out, and those earnings are yet to be seen. So the profits that Nifty auto companies did in 2018 was 28,000 crores. And this year, after a recovery, we are expecting 19,000 crores. So it's almost a 5 years of a return off or a slowdown or a down cycle, whatever you want to call it, on that extremely low base, we're expecting FY24 to show some good recovery because supply side issues are getting addressed, demand is fairly stable, and commodity prices are correcting. That aside, selectively we like consumption, both staples and discretionary, and then IT. That remains our another preferred sector. I know it is facing a bit of a challenge given what is happening in US and Europe, but I think it's a sector which offers very strong cash flows and balance sheet and excellent payout free cash flow fund conversion ratios. So any downside in IT, we would look to buy into that.
Okay, that's an interesting perspective, especially ahead of the earnings at a time when most analysts are a bit wary and a bit cautious about how things could pan out. I want to also talk about the big performers of 2022, the likes of Bank Nifty. You saw Auto Index also log in double-digit gains. Nifty Bank was up more than 20%. Do you expect this year as well to be so stellar for these sectors, even PSUs for that matter? The way the PSU index also, ran up. Do you think they will still be as solid and as resilient this year as well?
So see, it's always it's difficult to predict which sector will do well which year. Exactly a year and a half back or 2 years back, banking was on the other side, IT was on the other
Yeah.
side. 2022, the tables turned. PSU, in fact, we put out a thematic report on PSU resurgence of last 12 years. After, earnings going nowhere from 2011-12 to 2020, in the last 2 years, earnings have tripled for PSU, right? And index, which has done nothing for last 10 years, has finally started moving up because there is a lot of sector-specific tailwinds which are emerging in PSU. The biggest of them in PSU banks, where we have seen earnings exploding for last 2 years because the balance sheets have cleaned up, asset quality issues are behind, and credit growth has started picking up. So PSU can continue to do well because there is a momentum with them as far as different sectors are concerned on earnings, and both valuations remain quite cheap. Maybe one or two sectors here and there may have become expensive now after a strong outperformance of the last 12 months. But by and large, as a construct, PSU pack still remains cheap, and their ROEs are also improving. Their growth is picking up. So I would bet on PSUs depending on sector and stock specific sort of ideas. As far as other sectors are concerned, I would say that some of the beaten down names, for example, last year, PSU Bank index was up 71% and IT index was down 26%. Generally, such sort of divergences do not continue. So I do expect that once there is some clarity on how the global growth is shaping up, where we are in the global recessionary cycle, I do expect IT sector to start performing. Though those who are short-term oriented, they may find the going tough because a lot of things depend on quarterly results, what the management commentary is. But if you again zoom out over the last 10, 12 years, IT sector has been one of the most consistent performers on profit, cash flows, payout ratios, and of course, overall wealth creation. So that long-term track record gives us confidence in IT, and therefore that's why I said, if a quarter or two goes bad and you get stocks at a slightly more attractive prices, it's a sector where one should, bet on. And then, as we are entering in a year where there are 7 to 8 state elections, and then 2024, where we will see the big one, general election, I would think that governments, both state and center, would want the rural consumer sentiment to remain upbeat before going into elections. So therefore, we expect some sort of a spending, to pick up from the government side on the rural areas. And given the underperformance of rural over the last 1.5, 2 years, there are some sector-specific, stock-specific opportunities where the risk-reward looks quite attractive now on the rural side as well.
Okay. So if that were to happen, I mean, that's something that you're expecting in the budget, is what I would take it as.
No,
Will
budget,
that also?
Karuna, let me just expand that point a bit. See,
Okay.
budget has now just become a policy statement. Uh, you do not see big policy changes there. It's just a presentation of annual accounts. And to that extent, it, to my mind, has always been a very hyped up event. If you look at last 4 or 5 budgets, most of the policy changes that the government has done in the last 7 8 years have happened outside of the budget, right? So I won't go into the budget with big expectations. I would just see that, just expect that there will be some more tinkering in the areas where the government is trying to spend. For example, last 2 3 years they have clearly articulated and prioritized their infrastructure and capex spending. So that I expect to continue. Then, marginal tinkering here and there in favor of sectors where the spending can help drive the rural sentiments and rural consumption slightly better. But that aside, I don't expect any big changes to happen in budget. It will be an event which will come and go.
Okay. All right. If there was to, if you were to name one sector or one theme to watch for 2023, is it going to be IT according to you? But yes, there are a lot of ifs and buts associated to that. So if one has to ask you the theme to watch this year, what would you say?
See, if I have to play safe, I would say financials, because there the cycle has just begun. Credit growth just started picking up, balance sheets are the best, and you're still not seeing valuations out of whack. So that remains the most safest and consistent theme in my view. Second, I would definitely start, as I mentioned, looking at IT and consumption, because consumer staples has underperformed now for last 2.5 3 years. Hindustan Lever's price today and the price 3 years back was same. Britannia's price today and price 4 years back was roughly similar at about 4,000 rupees. So a lot of these stocks have undergone time correction, which was needed, given that they were trading at elevated multiples of 65, 70, 75. And if the rural sentiment picks up, then I would expect some of the consumer staple stocks to start doing well. And that aside, I've already explained how we want to play IT and auto. So those are 4 or 5 sectors where we will keep our eyes and ears open.
Okay, great. Then, Mr. Duggad, thank you so much for talking to us in great detail about so many sectors and what your thoughts are on the markets at large. With that, we're going to
Thanks.
wrap it up right here on Markets Weekly. Thank you so much for watching.